because I'm out of battery on that. Okay, but let's go ahead and let's start with Chapter 5 now. And remember that the gentleman that was here, and you guys like the panel too, so that's good. The gentleman that was here, I think he was sitting here, he had said that anything is included unless it's excluded, right? And then I kind of made the comment, yeah, but the way they include things are kind of weird sometimes. And again, we're going to continue to see that I think the exclusions are actually a little bit more straightforward, okay? They call out specific things that we don't have to include in income. And for some reason, to me, it's easier to remember what to exclude than what to include, okay? So let's just go ahead and start to take a look. And again, we're still up here in the 1040, okay, we're still deciding what things to include, what things to exclude. When we get into our next discussion, we'll come down here and we'll start talking about legitimate deductions to arrive at adjusted gross income, okay? But for now, we're still looking at what things specifically do or do not need to, or what can be excluded, all right? So you come over and you take a look, and they tell us the sections where we can find exclusions. And again, per the comment, everything's included unless it's specifically excluded, and they call out the sections. Okay. Now, if there are basically things that go on where you have living expenses from things like fires, casualty, loss, etc., and those are reimbursed through insurance proceeds, you can exclude those items. And we're going to see that for the most part, insurance is going to be something that's going to be excluded. Life insurance payments, payments that are covering losses for that involve, homes being destroyed by fire or other casualty losses, those are going to be excluded, okay? Another thing that is excluded is frequent flyer miles, okay? So when you earn frequent flyer miles that are purchased for business use, they are not going to tax those, and really the problem is tracking those, and that gets too difficult. So we start to get into the ease of recognition issue that we talked about earlier, and those would be excluded, okay? Coming over and taking a look at disaster relief payments resulting from terrorist attack, presidentially declared disaster areas, okay? These things, if there is going to be payments received for living expenses, funeral expenses, property damage resulting from the disaster, etc., those are not going to have to be included. Okay, so again, where you're getting payments when there's been some sort of catastrophe, fire loss, those sorts of things, they're not going to require you to pay tax on those. Okay, and that's sort of a general theme. Okay, coming over, gifts, and gifts are not going to be taxable to the recipient. Okay, and this includes gifts that are made during the life, which they call in vitro gifts, but not in vitro, that's something else. Inter vivos gifts and transfer that takes effect upon death, which is basically an inheritance. Okay, so they're not going to tax us on those things. Now, that's what not taxable to who? To the recipient. Okay, to the recipient. Remember, we said that in Chapter 4, the person giving the gift would have to pay the tax. However, there are what? There are limitations on that. And the limitation is pretty generous. It's what? Under the current tax law, it was about $5 million, a little over $5 million. Under the new law, it's going to be $11 million. It's not going to be taxable. So may you be so lucky as to have to pay an inheritance tax. But it's not what? It is not the individual that is receiving the gift. It is the individual that is what? Providing the gift. And then, of course, you have the what? $14,000 a year annual exclusion as well that you can be giving. And if you go over that $14,000, then that counts against the lifetime of 5.2. But we'll get more into that, I think, when we get this later chapter 27. Okay, but gifts are excluded for the purpose of this chapter from the recipient of the gifts, for the recipient of the gifts. Okay, so we have an example. Father gives gift to the daughter, but any interest that is earned after, however, remember we said is what? Is going to be taxable to her. So even though he gives her the stock or whatever, or bond, whatever, and that's not taxable, any earnings from that, once she receives that gift, is going to be taxable to her. Okay? And then they kind of talk about, gifts that are being given for impulses like affection and respect and admiration, all those things that you say to people during the first couple months of relationship, that you never say again, those sorts of things. So respect, admiration, that kind of stuff, okay? That love stuff, okay? And notice, therefore, what constitutes a gift is based on the donor's intent, right? If the donor is saying, hey, I'm doing this because I love you, I admire you, then that is going to constitute the gift, okay? Okay, good. Come over. Stop me if you got a question, guys, because I'm going to kind of roll here just so we can get through this chapter and get on to the questions from this next time. Okay, good. Transfers by employers to employees do not constitute excludable gifts, right? So, your employer can't say, well, I'm not really paying you a salary because you are my tax CPA and you did all this work for my firm. I'm really giving you this money because I love you so much. Oh, great. Thank you. I don't have to pay the tax on it. Okay. That's not going to work. All right. And so what we're going to see is it's going to be pretty much de minimis sort of things. I shouldn't use the term de minimis because de minimis has a separate meaning, but it's going to be things like, employee achievement awards. So they give you one of those, probably one of these things that you'll get early on in your career. You'll get a nice piece of lucite that'll say, thank you for being the first one to do this. You don't have to pay the tax on that, okay, that kind of thing. They give you a gold watch after you retire. You don't have to pay the tax on that, okay? So it's more of these tokens of appreciation are excludable if they come in under an employee achievement program, okay? So generally, property awards given to employees, watches, etc., are not taxable if the following conditions are met, and the award is of a tangible item. Okay, again, that piece of lucite, the gold watch, the plaque, the ring. Okay, if they give you if they give you award of cash, gift certificate, intangible items like vacations, meals, lodging, tickets to sporting events, bonds, those are. So if it's just something that's token, a tangible item like a watch or the plaque or something like that, then that is not going to be taxable. But if they give you cash, that is, and they will include that in your income in your W-2, and you'll have to pay tax on that. Okay. You come over and you take a look. Oops, did we decide not to use green? Or was blue we're not using, right? Okay, but that's a darker green. We don't want that one. I think this one is the better one. Okay, the cost of awards does not exceed the amount you can deduct as business expense. So if it's a annual award program and it's qualified program, it's $1,600 per year. If it is something that is not for a award program, then it's going to be $400. So they'd have to have a certain type of program that allow them to give you $1,600 of awards. If it's $400, if it's not, then $400 is going to be okay. And again, the items that we're talking about intangible things. So what happens when Tom Brady wins the Super Bowl? Do you think the ring that they give him is qualifying for this $1,600? You guys know who Tom Brady is, right? Okay, football player. Okay, the guy wins. You don't know Tom Brady? Okay, you probably know his wife. Do you know Giselle, his wife? Okay, the model. Okay, so what happens? You sit there and you give a ring like that, then that's going to be taxable. That's clearly more than $1,600, right? And again, the cash award that they get for winning the Super Bowl, that's all taxable, right? Regardless of the amount. Okay, good. Qualified plan is given as part of an established written program, and it can't favor employees who make more than $115,000 of income in the preceding year. Okay, so it has to be given as part of an awards program, and it can't favor employees who are making more than $115,000 a year. In other words, you can't say, well, when you retire, worker, we're going to give you a gold watch that's worth $400, but if it's someone who was the chief financial officer, they get a $1,600 gold watch. It can't do. I'm assuming that person's making more than $115,000, so it can't be discriminatory, essentially. Okay, and it has to be given during a meaningful presentation, whatever that means. I guess that means they can't slip it to you when no one's looking, right? So they're going to have to be explicit about that. Okay, so let's take a look. Employer payments, and if it's because you were part of a disaster and they're helping you to pay living expenses, etc., that is excluded. So I don't know, maybe I would imagine during Katrina or something like that, you probably had employers that helped their employees out to get shelter, that sort of thing. Those would not be included. You would be able to exclude those. Okay, good. Let's take a look at payments when they come to the family of a deceased individual. Okay, and if the decedent had non-forfeitable rights to the payment, then those would be taxed. Okay, so in other words, non-forfeitable right, the guy already worked and then he died. Sometimes I think to myself, is it better to die? It's better to die on Sunday before you go to work or Monday when you're coming home from work? I always think about that sometimes, right? I guess it'd be better Sunday before you go, right? And then you don't have to work that day, okay? But if you did, the amounts that would be paid would be accrued salary. Those are what? Those are going to be taxable because you still would have had to pay the person even if they had lived to receive it, right? Okay. Now, if you're sitting there and there are payments that are made to surviving spouse, okay, or the children of the decedent, then those will not be taxable. The employer derived no benefit from that, okay. They didn't have to perform any services. You don't make the kid come in and do that job, for that day, and then you pay the salary or something. Decedent had been fully compensated for any services rendered, and there's a resolution that they'll pay that. Okay, so if it's money that they owed already for work already done, we don't get to exclude that, right? But if it's, hey, since so-and-so died, here's some money to help get you through, the company has decided to pony up for this, untimely death, whatever, then that is going to be excluded. Okay, good. That gets us over to life insurance proceeds. Okay, and essentially, life insurance proceeds are what? Are exempt if they are paid solely due to the death of the individual. So we've got Mark. Mark pays $45,000 in premiums, and then all of a sudden he dies. So Linda gets, $200,000. The $200,000 is exempt. Okay, so we don't sit there and say, well, how much did he pay in premiums? That's compensating her for the death of her husband, I guess, in this case. Although relationship to decedent is not what determines. So it doesn't have to be the wife. It's whoever the policyholder is, right? They do not have to pay that. It doesn't have to be the spouse or the kids or anything. Okay, coming over, if the owner of the life insurance policy cancels the policy and receives cash surrender value, okay, so instead of waiting to die to get the money out of it, I just go ahead and I cancel the policy, and they give me any value that is considered the cash surrender value of that, then I will go ahead and recognize a gain to the extent that I received amounts in excess of of the premiums that I paid. Okay, a loss is not recognized. So, this is something that people like about, these insurance they call a whole life that has a cash surrender value as opposed to term life insurance. Term life insurance, you just pay every year, and if you don't die, you don't get any money out of it. If you die, the person gets the money out of it that year. With a whole life, it has this cash surrender value, which is sort of like a savings component, so that at some time, let's say you get the insurance policy and then your kids are all grown. You say, okay, I don't need this policy anymore for my kids or whatever, and you cash it in, then any amounts that you get that are in excess of the premium that you paid are going to be taxed. The losses, if it's had a cash surrender value less, is not going to be recognized. Okay, good. Let's take a look at accelerated death benefits. What happens here? Well, let's say someone's terminally ill, and the insurance has a provision that in that event, they can start to draw for that insurance to help cover medical expenses, that sort of thing. Then for accelerated death benefits, gain on surrender or transfer of life insurance policy by terminally ill is excludable. Okay, exclusion for chronically ill is limited to amounts for long-term care, and a terminally ill person is someone that they've determined is going to die, reasonably expected to die within 24 months. And I don't think it works, guys. You read that and say, so if you live 25 months, you got to pay the tax or something? No, then you've kind of outlived the expectation, but they're still expecting you to die in 24 months at some point. Then you wouldn't have to pay the tax on that. It's kind of I don't know. I was reading some of these things. I'm like, God, I hope this is great. Nice to know. Okay. I mean, you have to die. You have to be dying to get this benefit, right? Okay. Now you come over, and if there's transfer for valuable consideration, what happens here? Well, now I transfer the policy to you on the life insurance, and you're going to get the benefit when the person dies, and you give me some money. Okay, well, if that's the case, the person's going to have to pay tax on any amounts they receive on the insurance policy that was more than what they gave you to be the one that has the right to receive that in the event of the death of the individual. Okay, so if the policy is transferred for valuable consideration, proceeds are taxable to the extent they exceed the amount paid for the policy. So you look at this example here, and you have the person pays $4,000 for an insurance policy, face amount of $10,000 on the life of Beth, and subsequently transfer the policy to Carol for $6,000. Then Beth dies, and Carol gets the $10,000. She's going to have to pay what? She can exclude the $6,000, the amount she paid, and of course she would be taxed on what? On the $4,000, because she got insurance proceeds in excess of what she paid for it. Okay? I mean, this looks to me like people that are in really bad shape and need some money, and are trying to get it as quickly as they can. So they sell the insurance policy, even though if they had waited, they would have gotten the full $10,000. But they must be in some desperate need of cash. Maybe somebody's pretty sick or something. Okay. Okay, good. Come over and take a look at 5 exceptions to the rule in the preceding example. Okay, and they give us basically, if you look at this list, guys, and I'm not going to read through the whole thing, but if it's somebody that would have benefited from the policy, such as the insured under the policy, a partner of the insured, okay? If you have this sort of situation, then they will not make you pay the tax on any increases. So any amounts in excess of the fair value consideration given. So we have this Emily was born, and her dad purchased an insurance policy on her. When she was 24 and graduated from college and got married, he sold the policy to her for its fair value. Okay, when Emily dies, the transfer of consideration rules will not apply. So even though she maybe paid $6 and she got what? she got 10 for it, or whoever her she would get the 10, but whoever her beneficiaries were, they would not have to pay that tax on that 4,000 like we saw in the other example, okay, because the transfer was to the insured. Okay, good. Come over. And investment earnings arising from reinvestment of life insurance. So now the person dies and you take the money and you invest that money, right? You don't go immediately out and start spending the money. You just go ahead and invest it. Then what? Then there would be a tax on the increases in value. And that includes any investment earnings from money that's invested. And that includes if you decide to take the money in installments. So instead of taking the full, $1 million insurance policy, whatever, you decide you're going to take, so much a year for the next 20 years or something. Well, remember when we had the example of what you invested versus what you pull out is the portion that you would take when we were talking about taking annuity payments. Okay, the same sort of thing applies here as we talked about before. This is essentially an annuity in that portion of the amount you receive each year would be excluded, and a portion that represents the increase in the value would be included. And it's the same sort of thing that we did. Remember, the guy gave so much that he had invested and he got so many payments, and then once the payments are more than what you've invested, you take more payments out than what you invested, then those will all be taxable after that. Okay, scholarships and fellowships. Okay, some of you may actually have some experience with some of these. Over the years, I've had students that will ask me about this sometimes. Okay, and so what? It is non-taxable as long as you use it for school supplies, okay, books, computers, tuition, that sort of thing, okay, things that you're going to use for school. You can't use it for what? I mean, you can use it for that, but it's going to be taxable if you use it for room and board. So if you're paying your rent on your apartment, you're paying for, beer. You guys are not old enough to drink beer, but whatever. If you use it on sodas, pizza, whatever, that is going to be what? That portion would be taxable. So it's only the things that relate specifically to the education. Okay. Now, if you are sitting there and you are paying a teaching assistant, okay, I guess I can mention our buddy Derek here. I don't think he'll mind, right? The amount that is paid for that sort of thing, that is taxable. I mean, because you're working for those funds, right? So that would be taxable. Okay, you would have to include that. Okay, if it's an athletic scholarship, they do not tax those. Okay, as long as there's no specific requirement that you participate in a certain number of games or something, because then it's more like compensation. But if you're just coming and say, hey, you got a scholarship, you're part of the team, we're going to pay your tuition, they're saying that what? You are developing that particular skill, whatever it is that your sport that you're engaging in, so they'll consider that tuition, as long as they don't make it all about how many games you play or something. Then that would turn. I don't think they would do that. They would just go ahead and provide you the scholarship, and then if you end up not playing for some reason, probably it ends after a couple of years or something like that, and they won't pay your tuition anymore. Okay, good. Take a look at the next slide, and we do have an exception. If it's compensation for services for a nonprofit educational institution, can provide qualified reduction plans for their employees and their employees' family members. Okay, so what happens? Let's say I teach here at Berkeley, and they say, okay, John, we're going to allow you to let I don't have any kids. Well, we're going to let you, take classes for free. Well, I could exclude that tuition if you're an employee of the organization. Okay. Again, it's going to be what? Amounts for fees, books, supplies, and what? Athletic scholarships are what? Generally exempt. So I'm kind of repeating that same thing that I had on those other two bullets here. Okay, so let's look, and again, guys, the screenshot thing, what I'll try to do is where there's, examples, I'll put those in, just because it's the best way to put it in. They come right out of the book. I think you recognize the book's designation for examples. Okay, so Kelly received an athletic scholarship from State University. The scholarship pays her tuition, $9,000, and books and supplies, $2,400. She also received $4,500 a year for cost of attendance, and she used that to pay for housing, food, laundry. What do you think? The housing, food, laundry stuff is what? That's going to be taxable. It is only the tuition, books, those sort of things, stuff that you actually use to study with. Okay. If they offer these scholarship opportunities for just key employees, then if that's the case, it's going to be included in the parent employee's income. So they can't just say, hey, it's just for the, president of the university or something. They'd have to offer it to all the employees. Okay. All right. Scholarships, timing issues. And all that we get into here is, well, what happens if I receive the scholarship in year one, but I don't know how I'm going to use that money until the next taxable year. So I really don't know how much is actually for tuition, scholarships, that sort of thing, and how much is going to be relevant to room and board, those sort of things, because I have to pay tax on that part. Well, they allow us to just hold that whole transaction open until it is determined how much is actually qualified for education expenses. So you look at this one here, and we've got this kid who's getting a $10,000 scholarship. I assume he's a kid. He's a grown man. This is Sanjay. I don't know, is that a boy or a girl? I don't even know. But whoever this person is gets a $10,000 scholarship, and we want to know how much would have to be income. And so what happens? Well, since he paid finally in that next year $7,500 for the excludable things like books, that sort of thing, then only the $2,500 is going to be included, and he could wait until the next year when he finally files for that, because now he knows what those expenses were actually for. Okay, good. Let's take a look at damages. Okay, and when we look at damages, I won't put you in the bad position. Somebody is at the grocery store and they slip on a banana peel. Bam, hit the ground. And now we've got this situation where there's going to be loss of income, there's expenses incurred, they broke their favorite necklace in the process, so property's been destroyed, and they have, this personal injury, okay? And so let's see how we're going to deal with that. When we say personal injury, depending on how serious the injury is, the IRS will look at some of that as compensating you for something like losing a body part or something horrible like that, and some of that will not be taxable. Okay, so let's just look at those. Tax treatment of damages received for loss of income is going to be what? Is going to be taxable, because they're essentially replacing the income you lost due to the injury, right? Okay. Now, if it's, we're going to talk about some exceptions to that related to personal injury, like if you lose a limb or something. But generally, the tax is taxed the same as the income it replaced. Okay. Reimbursement for expenses incurred. You have run up a bunch of doctor bills. That is not income unless the expense has been deducted. And so what happens? They allow you to deduct medical expenses that are in excess of certain percentages of your adjusted gross income. So let's say you take those deductions for those medical expenses in year one, and then you're reimbursed for the medical expenses from this damages in year two. You would have to include what? in income the amount that you had already deducted because you got a tax benefit for that in the previous year, right? Since you were able to deduct that in the previous year, they would make you include that in income. And that's going to be something we'll see towards the end of the slides here. It works the same deal with a tax refund. If you deducted your state and local taxes, although your buddy Trump has limited how much of that we can actually take now for, all states, but California, I think, gets hurt more than that than others. But if you were able to take a deduction for that on your itemized deductions, and then the next year you get a refund from the state, you'd have to include that refund as income because you got a tax benefit for the itemized deduction from the previous year. They call that the tax benefit rule, and we'll have a slide specifically on that, but that's basically what we're talking about here. Okay, now you come over and you take a look, and if you have property that has been damaged and you receive an amount, we treat it as though you sold that property. Okay, and so there will be a gain for any amounts you receive that are in excess of your basis. Okay, so again, someone slips on the banana peel, they fall down and they break their, grandmother's priceless necklace or something, right? But their basis in that property was what? Zero, because the grandmother gave it to them, right? So when they get paid for that now, $10,000 because it was, a Russian heirloom or something like that, what's going to happen? They're going to make you pay tax on that $10,000 because your basis was zero, as though you sold your grandmother's necklace, whatever. Okay. All right. Personal injury, we have special treatment for those. Okay, and we're going to see those on the next slide. And we have special treatment for those because they look at some of these things, these personal injuries, as so devastating that they are not going to make you even pay the tax on that. Okay, but let's take a look at these. You got to pay a pretty serious price. First off, personal injury, and it has to be a physical injury. Okay, they're not going to let you exclude amounts that you receive because of mental pain and suffering. Okay, so it's got to be physical. Okay, so it's physical personal injury or physical sickness. Okay, all other injury damages are taxable, including if it is a compensatory damage for, as we've said, non-physical amounts received for age discrimination. Okay. Or injuries to one's reputation. Punitive damages. Punitive damages are essentially damages that are there to punish the bad person. So, if somebody went out and said all kinds of bad things about you and damaged your reputation, okay, the courts will provide you for that damage to your reputation, right? And say, well, now nobody is going to ever let me do my tax returns because they slandered me and said that I was, that I made all kinds of mistakes when I really didn't, okay? And they're not saying things that are opinion. People can say their opinion about you all day. Someone can sit there and say, I don't like John because, I don't like bald guys or whatever. They can say that if they want. Of course, you can't discriminate. You can't say, I don't like John because he's Puerto Rican. That would not be okay, okay? But you could say, I don't like people because, I don't like this person because he's just not a good person. Well, that's your opinion, right? But you can't say that the person, stole from me, or he was, did this, terrible thing, and you didn't actually do that. That's called slander, or if you put it in writing, that's liable. And you could be what? You could be having to pay me for the damages you caused to my reputation, right? But then the courts will go further and they'll say, and just to make sure you understand that you're a bad person and you did a bad thing, we're going to make you pay John punitive damages. That's on top of the restoration of my reputation. I'd have to pay tax on both of those, the punitive damages plus, the damages that you did to my reputation, etc. Now, if you came up to me and hit me with a baseball bat and broke my arm, then I would not be, I would not have to pay tax on that. So I don't know. what do they say? Sticks and stones may break your bones, but words will never hurt you. Well, just know that if the words will hurt you more if you have to pay tax on them, right? Okay, so, all right. So you come over and you take a look at the next slide here, which I thought was an excellent summary. Okay, I thought this was a real good summary, so I'm just going to go ahead and kind of put a couple stars on that for you. I'm not going to go through it in detail because it's kind of the main things we talked about: property damages, personal injury, all amounts are excluded unless previously deducted. Physical amounts received as punitive damages are included. So I thought that was a pretty good summary. Compensatory damage for punitive damages are included. Gross income if it's non-physical. Okay. All right. Wrongful incarceration. And, I looked at this and I'm like, did I skip one? Seems like something got skipped here. No, we're good. Wrongful incarceration, and it's kind of like, okay, this is amounts received as damages for being wrongfully incarcerated will be excluded. So, the government throws you in jail for 25 years. And because they threw you in jail for 25 years, you get paid, $500,000. So they don't make you pay the tax on that. I'm kind of like, geez, thanks a lot. Okay, so, let's hope that you don't end up with a wrongful incarceration. Workers' compensation is sort of counterintuitive in that you would think that since they're paying you for lost wages here, that that should be included, but no, they exclude the workers' compensation. You don't have to pay tax on that. I guess they're probably looking at that and saying, well, look, the workers' compensation is probably some sort of government benefit. Does it make sense for the government to pay the benefit and then turn around and tax you on that benefit at the same time? But regardless, they don't tax that. I guess maybe they're trying to help somebody out if they've been injured and have to take workers' compensation. Okay. Accident and health insurance benefits received under policy purchased for taxpayer. You do not have to pay tax on that, even if it is suitable for substitute for income. So you have that, what's that duck, that Aflac duck that talks about paying you supplemental insurance while you're out that's supposed to be beyond what you would get for workers' comp, to help cover you. You don't have to pay the tax on that. Okay, so let's just take a look and see this example here with this Bonnie. Purchases a medical and disability insurance policy. Insurance company pays Bonnie $1,000 a week to replace wages she lost while in the hospital. Even though it's a substitute for income, they do not have to pay taxes on what they collect. She doesn't have to on what she collected under that insurance policy. So that's the benefit there if you get some sort of supplemental insurance that goes beyond workers' comp. And some people do that because they look at it and say, if I'm injured while I'm working, I'm going to, not get enough from workers' comp. So you get some supplemental insurance. You don't have to pay the tax on that. So the workers' comp and the supplemental is covered at the same time. I don't know the web data. Uh-huh. Example 10, right here? How would it change if the taxpayer was what? So they're receiving the money in year one, and they're paying for the books, etc. in year two. Still, and you're saying if they were an accrual taxpayer because they're receiving in year one, they should take the income in year one. No, I don't think that this is going to be relevant because all we're doing is we're holding back this 10,000 because we don't know what portion of it is going to be for tuition versus other expenses. So I don't see that the accrual or cash basis of the taxpayer is relevant. It's knowing what portion of that total 10,000 was actually excludable as tuitions and books and that sort of thing versus money for pizza, room and board. So I don't see that it changes. It's waiting, it's holding back to the recognition for tax purposes until we know what portion is what, because some is included and some is excluded. Okay. I'm just kidding about the Raider fan. I say that because I'm a Raider fan. I don't think anybody else was a Raider fan anymore. You don't have like one or two left? Okay. Okay. All right. So you come over and you take a look at this example. Now, different rules apply if the accident and health insurance protection was purchased by the individual's employer. So in this case now, you know, the employer is purchasing it, and really all we're going to get into here is whether or not the premium being paid is actually taxable or not. Okay, and we're going to find out that it is not. So premiums paid by employers for insurance coverage of employees, spouses, dependents is not taxable. Okay, now the amounts that we received are not taxable when used for medical care or for permanent loss of a body function. Okay, and this is the one that, I don't know, when I read some of these examples, I'm like, gosh, geez, okay, that's horrible. Okay, so Jill loses an eye in an automobile accident unrelated to her work. As a result of the accident, Jill incurs, that's all it costs to lose an eye. I guess if they don't replace it, what else are they going to do? How can they replace it? $2,000 of medical expenses, which she deducts on her return. She collects $10,000 accident insurance carried by the employer. The benefits are paid according to a schedule. $10,000 for a loss of an eye, $20,000 for a loss of a hand, etc. Because the loss is for a member of function of the body, the $10,000 is what? Is going to be excluded from gross income. And notice that what? It doesn't matter that the 2,000 medical expenses aren't taken off of that 10,000, even though she deducted them. They're seeing that as a compensation for the fact that you lost a body part or whatever, and they do not tax that. So they don't sit there and say, well, it's because she took 2,000 of expenses last year, she has to subtract it off the 10. The entire 10 is not taxable. Okay. Now, if the employer gives her, you know, money for the day, and she only misses a day of work, I mean, give me a break, okay? So what happens? They sit there and you're going to work the next day, lost an eye. Yeah, no problem. Looks great. Don't worry about it, right? So I think she loses one day. But that one day that she loses, you know, they give her the income for that, then that is taxable because that's compensating for the missed work time. Okay. Okay, good. Come over. And let's take a look at payments for expenses that do not meet the code definition of medical care. Okay, then you have to pay tax on that. So if you have a sponsor-employed health plan that pays for a hair transplant, no. Okay, they're not going to do that for you. So basically, what they're saying is they'll pay for medical expenses that can get you back to baseline. You know, so if I have an employer that says, you know, we'll do some surgery on you, John, you'll look just like Brad Pitt when you're done. That's going to be taxable, right? Okay, because that's not taking me back to baseline. Okay, so, okay, hair transplant that. You could say, well, but you had hair at one time. No, that doesn't work either. Okay, doesn't work either. Okay, me back to my 16-year-old self. Okay, now amounts received for medical expenses deducted in a prior return, those are included. Again, that's that tax benefit rule. If you took a deduction because your medical expenses exceed certain percentages of AGI in year one, and then in year two you get reimbursed for that, you have to claim that reimbursement in that situation. Okay, good. And you come over and take a look at these employer-sponsored medical plans, and if in lieu of providing the employee with insurance coverage for hospital medical expenses, the employee may agree to reimburse the employee for these expenses. The amounts received through that are going to be what? Excluded. So sometimes you may have an employer that says, hey, I'm not going to pay for an insurance policy for you, but we'll cover any expenses that you have for your medical. Then you don't have to include that. I'm thinking the employer that would do that would be what, like Stanford Hospital or something. You're a nurse at Stanford Hospital, and they say, hey, anything you get, we'll cover the cost of it. They're essentially going to just send you to their facility, right, and cover it that way. And that may be cheaper for them than paying the insurance. Okay, good. Now you come over and you take a look at this example here, where we have the health sponsored accident and health plans. Okay, so what happens? The employer could purchase a medical insurance plan with a high deductible and then make contributions to a health savings account. Okay, now the employer's contribution to the health savings account and earnings on the account are excludable. Okay, contributions, however, are limited to for deductible amount for an individual or family coverage. Monthly deductible amount is limited to the lesser of 1/12 of the annual deductible, or $3,500 if it's self coverage, $6,750 if it's family coverage. So they can go ahead and give you this coverage with a high deductible, and then they'll put money into an account for you so that when you have to pay that high deductible, they give you the money to cover that high deductible. Okay, and they can only put in so much and have that excluded from your income, and you see the limitations there. Now, withdraw from the plan are excluded to the extent used for qualified medical expenses. So then when you have the medical expenses, you have to pay that high deductible amount you deduct out. You don't have to pay the tax on that. And I guess those higher deductible plans are probably a little cheaper for the employer, and then they go ahead and kind of hedge against that high deductible by making those contributions. And again, the contributions are not taxable, and withdrawals that you use for medical expenses are not taxable. Okay. Employer paid insurance premiums for employees' long-term care are excluded, and it's subject to annual limits that we'll see on the next slide. I'm not sure why I didn't put some of these on this slide. A lot of your employers will offer you a plan where you pay a premium, and then if you have some sort of accident when you're in the hospital for 2 months, 6 months or something crazy like that, they will pay for the long-term care. I tried to get one of these for my dad when he was like 80 something, like 82 or something like that, and they wouldn't give it to him. They just refused us. They went and asked him like a bunch of questions and said that he wasn't able to answer the questions. And like the questions they were asking him, I couldn't remember. Like they said, we're going to give you 5 words and see if you can tell me the 5 words that you said back that we said to you in the opposite order how you said them. And I'm kind of listening from my room, and I'm like, well, I got 2 of them. I can't remember the last 3. So maybe I'm not eligible for this thing either. So the older the person is, the harder it is to get them this long-term care insurance. So if you have an employer that offers you that, get it while you're young, and then you'll probably pay a pretty good benefit. And it's there for you if you have a bad accident or something and you're laid up for a long time. So these are kind of good benefits, okay? But the premiums are deductible, subject to the limits that you see over here, which exclusion of benefits received from the policy. It's $360 in 2017 for each day the patient receives the patient care or the actual cost of the care, whichever is greater. And then it's reduced by amounts received from other third parties, say damages received. And in this example, we've got this Mary or Hazel who suffers from Alzheimer's, a patient in a nursing home for the last 30 days of 2017. While in the nursing home, she incurs costs of $7,600. Wow, that's for a month. And Medicare pays $3,500 of the cost. Hazel receives, though, $7,600 from the long-term insurance care. You see why you want long-term insurance care? I mean, that's a lot. And if all you had was some sort of, Medicare payments at $3,500, she's older, so she gets Medicare, you could quickly run through any money that you had, right, to pay the difference. Okay, but she gets that $7,600 of insurance. Now, the amount that Hazel may exclude, they have the daily statutory $1,080. The actual cost of the care is $7,600. So which one is more? The daily amount. Okay, so we pick up that $1,080 less the amount that she received from Medicare. So the amount of the exclusion is what? $7,300. And because she did what? She received $7,600, she's got to pay tax on that difference. So you can't go around, making money, because you got reimbursed for being in a nursing home, right? And so they make her pay well, she did do that, but she's got to pay the tax on that. It's not a tax-free consequence. Okay. All right, good. Meals and lodging. Okay, what happens here? Not taxable to the employee if furnished by the employer to the employee spouse, dependents on the employer's premises for convenience of the employer. And if you go into tax, you will absolutely have meals and lodging provided to you for the benefit of your employer, because they don't want you to leave, because they want you to sit there and grind out tax returns long into the night. Okay, so if that's the case, they always, they'll order in, they'll pass around the menu, and then everybody gets to choose what it is they want to eat or whatever, and then they bring it in. Well, you don't have to pay the tax on that, because that's for the advantage of the employer. Okay, now in the case of lodging, the employee is required to accept the lodging as a condition of employment, then that is not going to be taxable. And so this Kahil is the manager of an apartment, and they set him up with an apartment that has a value of $9,600 a year. Okay, he doesn't have to pay the tax on that, because they want him there on the premises, being the manager. If somebody gets locked out or something, they have someone there at all times to open the door, whatever. Okay, and so he wouldn't have to pay the tax on that. Okay, going over, employee of an educational institution may be able to exclude the value of housing provided by the employer. And it's pretty generous here. Generally, the employee does not recognize income if they pay annual rents equal to the greater of 5% of the appraised value of the facility. So that's not too bad. Okay, so they'll go ahead and not make you pay unless you're paying amounts that are equal to 5% of the appraised value. If rest payments are less than 5%, then that deficiency must be included in gross income. So 5% is a pretty low threshold there. Okay, ministers. And ministers can exclude rental value of a home furnished as compensation. Okay, a rental allowance paid to them as compensation to the extent the allowance is used to rent, provide home, buy a home, and rental value of home owned by the minister. So that's pretty good too. And you look at that and say, well, why? I mean, why would we be providing this? And it's because we like religion in this country. It's the only thing I can think of as to why, they're going to let the rental value of the home owned by the minister that it's being provided to them to be excluded. I think this is just because we like religious entities. Okay, so we provide them a little benefit there. Okay, good. Let's take a look at other fringe benefits. Dependent care up to the cost paid by the employer can be excluded up to $5,000. Okay, $2,500 if it's a married individual filing separate. For a married couple, annual exclusion cannot exceed the earned income of the spouse who has the lesser amount of income. And for an unmarried individual, the exclusion cannot exceed their earned income. Okay, so we don't want you taking a tax credit, for the child care that dependent care that they're giving you. Okay, athletic facilities, gyms, you can exclude that. They're not going to make you pay tax on that. Educational assistance programs. Okay, employer provide educational assistance for undergraduate and graduate education. Exclusion of $5,250 per year. It has to be for tuitions, fees. Does not cover what? Meals, lodging, transportation costs. Also, you can't send someone to school for poker playing. Okay, yeah, we're going to make you the poker champion. We're going to send you to school for that. Don't worry about it. If they pay your tuition for that, that's going to be included. Okay. Take a look. Adoption assistance. Okay. And they will let you exclude money for adoption assistance, but the exclusion is limited to this $13,570. However, if it's a special needs child, they'll still allow you the $13,570 or the actual cost for not a special needs child. But if it's a special needs child, they'll let you deduct the $13,570 even if the expenses are less. Okay, so just trying to do something good there. But there is a phase out of that, and the phase out amounts start to phase out at $203,540 and are completely phased out at $243,540. And don't worry about it, I won't give you questions or talk about how to phase it out. Just know that it's phased out entirely at the upper end, right? And the phase out begins at the lower end of this range. Okay, employees who can choose between cash and certain non-taxable benefits. Okay, if cash is chosen, the amount of cash that are received is taxable. Okay, so they offer you insurance, but they say, hey, you could take tax in lieu of that. And I have friends that although they don't get the cash in lieu, where I worked in the federal government, they didn't have you couldn't get the cash in lieu, but they don't pay part of the premium for certain benefits. Especially a couple of my buddies have spouses that work as a nurse and that sort of thing at Kaiser, and Kaiser has a much better medical plan than the federal government does, so they don't pick the medical, but they'll pick some other benefit, and they call these cafeteria plans. Okay, so if that's the case, you have this Hawk Corporation that's offering these different things, and there's these different benefits here. And if a benefit is not selected, then you can receive cash in lieu of that benefit. Okay, and so what happens? K, an employee, has a spouse who works for another employer that provides hospitalization insurance, but no child care payments. So K elects to receive the group term life insurance, the child care payments, and then takes what? Takes $2,400 cash for the hospitalization because she's getting that under her spouse's program. Then what? Only that $2,400 that represents the cash portion of that is going to be taxable. Okay, so sometimes they'll have that. That's not that common that the employer will let you take cash in lieu of a benefit. Usually you just either take the benefit or you opt out of it, and they won't give you the cash in replacement. Right. Okay, good. Let's look at flexible spending plans. And this one almost sounds like gambling to me. It's like, okay, put your money into a pot and hope that something goes wrong during the year and you have to spend the money on your health care, because if you don't, you'll lose the money if you don't spend it on your health care. And so I've known people that have got these flexible spending plans because maybe vision isn't covered by their employer, and so what they'll do is this money goes in, and then they have this money sitting in the pot, and they know they're going to lose it by March of the next year, so they'll go and buy 15 pairs of glasses just to use up the money that's in there. It's like, okay, you lost on that one. Okay, so it's kind of a weird way to basically avoid paying tax on some of your pay. Okay, so what happens is let's go ahead and turn that to highlighter. So it allows employees to accept lower cash compensation as much as $2,600, and then in return for the employer to agree paying certain costs without the employee recognizing that income. So you're taking lower pay and you're hedging that the employer will pay something when you get sick, and you avoid having to pay the tax first and then reach into your bank account and pay for that non-covered item. Okay, so for example, assume the employer's health insurance policy does not cover dental expenses. The employer could estimate his or her dental expenses for the upcoming year and agree to a salary reduction equal to the estimated dental expenses. So I guess, if you're sitting around there in December going, oh toothache, don't go yet, let's wait until next year and we'll get that taken care of, because we're going to, estimate our dental expenses are going to be pretty high next year. I guess you could do something like that, right? And so what happens? The employer then pays or reimburses the employee for the actual dental expenses incurred with the ceiling amount of the $2,600, the salary reduction. If the actual dental expenses are less than the reduction, the employee cannot recover the difference. And that's the part where I'm like, okay, great. So you lost because you didn't get sick enough. You didn't have a bad enough toothache. If only I'd had more toothaches, I would have made a deal on this, right? Or at least got my money back, okay? Not had to pay tax on that reduced income, right? Okay, so they now give you all the way till March 15th. Now to actually use that up. So if you don't use it up by December, you better hurry up by March 15th and go buy, I knew this guy who went and bought 15 pairs of glasses just to use up the money that was sitting in there in the account. I was like, okay, great. Let's hope those glasses stay in style. Okay? All right. So that's a way of doing it. I never thought these flexible spending plans were that great of a deal, but some people like them. Okay? Okay, good. Non-taxable employee benefits. Okay, we're going to go through each one of these, so I'm not going to read off everything on this slide because we're going to go through these on the next several slides. No, we're not, because it's 5 till already, right? So, yeah, okay, let's finish. We can finish this. We'll finish this, and then we'll finish the rest of them next time, and we'll put the quiz questions up, and we'll go through the quiz. So I'll put the quiz questions up, and we'll go through the quiz next time for Chapter 5, and as well as finishing this up. But let's go ahead with the time we have left. Let's see, get through these, okay? So, no additional cost services. What happens here? Airplane is classic example, right? Everybody wants to work for an airline when they're a kid because they say you get to travel for nothing, right? And that's true. You essentially travel for nothing, and you don't really have to pay the tax on that. They may look at somebody like me and say, geez, John, we're going to use up a lot of extra fuel with you on the plane, but that's generally not the case. You don't have to pay tax on that, okay? So if it is a no additional cost, okay, we're talking about services, employer incurs no additional cost, again, the airline. Services offered are within the line of business. If you're a flight attendant, whatever, that's obviously within the line of business. Benefit is offered on a non-discriminatory basis, everybody in the company, and no additional cost exclusion can extend to dependent children. It doesn't have to in order to qualify. They're just saying that even your family can fly for free and you don't have to pay the tax on that. So it's a pretty good deal, right? Okay. Now you come over and you take a look at employee discounts. So I'm kind of going fast here. So that's it on the no additional cost. Doesn't cost them anything more. Doesn't cost them anything more to have you have a seat on the plane. You don't have to pay the tax on that, right? Okay. Now you come over and we talk about employee discounts. Okay, not taxable if it is not on a realty or investment pool. Okay. Then what? Items discounted is in the same line of business. Discount cannot exceed gross profit on property or 20% of the customer prices it's on services, and benefit is offered on a non-discriminatory basis. Okay, so let's just go ahead and take a look, and this is a pretty good example here. And let's just look at the numbers. Customer price for the property is $500. Gross profit is $125. So after we back off the gross profit on that property, we have what, $375? If the employee price was $300, then the income is going to be $75. Okay, so if you work for, I had a friend that worked for, she worked for Banana Republic, and so she'd always get the employee discount, right? But you'd have to pay what? Tax if there was a reduction price that was more than 75% of the customer price, right? Okay, you take off the 25% of gross profit. Now, if it is for a service, they go ahead and they just take 20% off of the customer price. That's $120, and the employee price is $120. Then there's no income on that. I guess you're getting your hair cut or something. Okay. All right. Let's take a look at. Well, I'm going to stop, guys, because I'm kind of trying to rush it to the end here. We're already up on 2 o'clock. So we'll pick it up here, and we will go through the quiz. I'll put the quiz up. I'll get it sometime today, so look for the quiz. You can bring that with you. We'll try to do maybe 20 questions or so, since you guys are asking for more questions. And if you have anything in particular that you want to discuss with me in terms of how the class is running, please feel free. I mean, don't feel like you have to, keep it secret. If you've got personal feedback, I'm more than happy to hear that, okay? All right, guys. I will see you next time.